In the first 9 months of this year, 2022, the S&P 500 had its first three-quarter losing streak since the 2008 recession, and it's expected to get worse. Even in this bear market, high interest rate, high inflationary environment, or a recession, it is still the opportunity of a lifetime to come out on top. Take advantage of this recession so you can build wealth and be financially free. Hi everyone, it's the Portfolio Plug. In today's video, I'm going to teach you how to structure and build your portfolio so you can take advantage of this recession to come out on top, to build wealth and gain financial freedom. Do you know what this is? That's the Fear and Greed Index. It is used to gauge the mood of the stock market. And right now, there is extreme fear in the market. People are panicking. They're selling their stocks. They are afraid of the possibility of a global recession because we have the war in Ukraine with Russia, a global supply chain shortage, food shortages, product shortages, high inflation, and high interest rates. That's causing extreme fear in the market right now. Instead of panicking or being afraid of the stock market, this is the perfect time to start investing. The stock market has recovered from every recession. In fact, 7 out of the last 13 recessions, the US stock market produced positive returns. The first thing you're going to do in order to build your investing portfolio so you can gain financial freedom and build wealth is open up a brokerage account and fund that account. And if you have one already, then you are good and ready to go. Now, here's how you're going to structure your portfolio so you can take advantage of this recession. The core of your investing portfolio is going to be an index fund. This should be your biggest holdings because it will lower your risk and give you diversification across every sector of the stock market. Think of it this way. If a company underperforms, files for bankruptcy, or goes out of business, you would lose your money. But with an index fund, if a company underperforms, what would happen is they would just remove it from that index fund and replace it with another company that's actually performing well. Here's another example of why index funds are so important. Stick with me. I'm going to go over some data with you. Did you know that according to Vanguard, the average American has $141,542 saved up for retirement, with the average retirement age at 65 years old, and the life expectancy for people in the US is 78 years old. Not to mention, the cost of living is $61,334 with inflation in the US today. In other words, because the cost of living is so high, you're working 40 plus years, 47 years to be exact if you count the legal age of adulthood in the US at 18 years old, to enjoy 2 to 3 years of retirement before you have to get back to work. And the life expectancy is at 78 years old. But did you know if you were to invest $750, that's $9,000 a year in an index fund for the next 30 years with an average return of 10 to 12% annually plus compound interest, you would have over $1 million for retirement, allowing you to retire 17 years earlier. And if you want to retire even earlier than that, all you would have to do is just be more aggressive with the amount of money you're putting into it. Here are some index funds you can look into adding to your portfolio. SPY, SPY, or VOO, VOO. SPY is the SPDR S&P 500 ETF Trust, and the VOO is the Vanguard S&P 500 Index Fund ETF. And they both hold 500 of the largest companies in the US stock market. Then there's VTI, that's the Vanguard Total Stock Market Index Fund ETF. It holds the overall stock market. The second part of your investing portfolio is going to be dividend stocks. Regardless if the stock market goes up or down, recession or not, you're still going to get paid and have passive income from the dividends paid. Think of it this way. Imagine owning a bunch of rental properties, but without the hassle of keeping up with the maintenance of the properties or dealing with any tenants. That's pretty much what dividend stocks is. You're going to be getting a cash flow, which is your dividends pay from the stocks, which would be the same thing as if you were going to get your rental income from your tenants. Here are some dividend stocks you can look into adding to your portfolio. VIG, Vanguard Dividend Appreciation Index Fund ETF. VIG tracks the performance of a benchmark index of companies that have a record of increasing dividends over time. Some of the top holdings are Microsoft, Home Depot, Procter & Gamble, JP Morgan Chase, Johnson & Johnson, Visa, MasterCard, Coca-Cola, PepsiCo, and a bunch more. SCHD, that's the Schwab US Dividends Equities ETF. It's a low-cost fund that focuses on quality and sustainability of dividends, and it also tracks the Dow Jones US Dividend 100 Index. HDV, it's the iShares Core High Dividend ETF. It tracks the performance of an index that holds high-paying dividend stocks. Before I tell you what the third part is to building your portfolio so you can gain financial freedom and build wealth, I would greatly appreciate it if you hit the subscribe button and leave a thumbs up if you find this video to be helpful. The third part of your portfolio is going to be blue chip stocks and mega cap stocks. These are the big companies that are well established and have an excellent reputation of being profitable. These companies are at the top of their industry. They are the most popular, and we use their products and services or goods in some form or fashion in our everyday life. Here's to name a few, for example: Apple, Microsoft, Amazon, Tesla, Visa, MasterCard, Home Depot. I can go on for days. Just think of all the major companies that we use on an everyday basis. Well, even Disney. Think of how many kids watch Disney. Disney is the #1 streaming service in the world. Think of how many people that have an Apple product, whether it's the iPhone, the MacBook, the headphones, and so much more. And even Amazon. Think of all the people that order on Amazon, use Amazon Prime. Even recently, Amazon, they partnered with the NFL, Thursday Night Football. Not to mention, they also own Whole Foods. Think of how many people shop at Whole Foods. Even Visa and MasterCard. Everyone has a credit card or a debit card, and it has Visa, MasterCard. You can have an American Express. Even that one is a big one as well. It's a big company as well. So these companies, these are at the top. These are the everyday companies. These are the blue chips, the mega cap stocks that you want to look at. In the fourth and final part of your portfolio, healthcare stocks. We need healthcare in order to survive. Healthcare normally does well during a recession and after a recession. Take, for example, Eli Lilly is currently outperforming the market right now. 20% return on the stock this year. Johnson & Johnson, another great company right there. Not only do they pay a great dividends, but just think about during COVID, how Johnson & Johnson was doing very well. Why? Because we needed healthcare to step in because there was a crisis. So healthcare is always going to be around. And here's another example. AbbVie, ABBV. That's the ticker symbol. No one is really talking about it, but they're up 33% year to date, completely outperforming the market right now. So for the healthcare sector, we got Eli Lilly, that's LLY, UNH, United Health Group, Johnson & Johnson, J&J, Merck, MRK, AbbVie, ABBV. Look into adding some of these to your portfolio. To summarize, in order to gain financial freedom and build wealth, your portfolio should have index funds, dividend stocks, mega cap or blue chip stocks, and healthcare stocks. And don't forget to subscribe. Leave a thumbs up if this video was helpful or share it with a friend. And if you have any thoughts or questions, leave it in the comments. And thank you for watching. See you on the next video.